Hello, welcome to Connor's Corner. This is episode 2 where we'll talk about different types of investment accounts. We'll talk about that type, the key feature, the tax implications, and how you can actually put these accounts into your own life to help you out. Those main accounts are qualified, which are pre-tax or tax deferred, non-qualified, which are taxable or have capital gains / losses, and then Roth accounts, which are completely untaxed. Let's talk about qualified first, okay? These are ones that you're more than likely going to be most familiar with, right? So they're your 401k at work, maybe 403b. Also, if you're self-employed, it's the SEP IRA, the simple. If you're working for someone with a union, right? So you're going to have your monthly pension come retirement, or their traditional IRA. How do they work, right? So basically what they're doing is the IRS is allowing you to put contributions in today, write them off of your taxes, but in the future, the distributions will become taxable, which is why we call these accounts tax deferred. Okay, so basically imagine if you had 100,000 of income, you put in 10,000 into a 401k, on your tax return, you are going to pay tax on 90,000. So most companies are going to give you a company match, right? And I always say, take advantage of them, take the company match. So that match, though, is going to be on the taxable side. Okay, there's 99.9% I've always seen it that way. Okay, each different account that I talked about has a different annual contribution. I'm not going to bore you with just lining out what they exactly are, but age 50 plus does have a little catch-up amount too. All right. Key features are that an early withdrawal has a 10% penalty on them, all right, plus being taxed to you at your ordinary income rate. This still might be something that's advantageous to someone in a higher tax bracket, right? If I'm in a 32-40%, or I should say 32-36% tax bracket, I might want to be taking advantage of something I can write off against my income versus someone who's in a 10% bracket where it might be more advantageous to go the Roth route, which we'll talk in a little while. All right, you've saved in a 401k your whole life. Now what? All right, a very, very common example that I see with clients, especially older clients, are clients here like John and Tina. Right? They're about to retire. They've saved in their 401k their whole life, always on the tax deferred route or the qualified account. And now they're about to take Social Security. And how do they live off of that money? Right? They have a couple risks associated with that. All right, one, every distribution that they take is going to be at their tax rate. Okay, so we don't really have much flexibility. If they need the money in retirement, if we want to take $1 out of an investment account, it's going on their tax return, right? There's this thing called a required minimum distribution, or what I would call an RMD, all right? Currently, those start at 73. They've raised in the past from 70.5 to now 73, could be going to 75 in the future. Okay, what that means is the IRS is saying, hey, we gave you that tax write-off years ago. It's now we're going to force you now to take money out so you can pay us some tax. All right. And then let's say you don't make it to RMD age or whatnot, or you have money left over. When you pass, your beneficiaries are not escaping the tax either. They actually have something called the 10-year rule. And every dollar that you pass them has to come out within 10 years, and it's going to be taxable to them too. Okay, so this gets into a huge amount of estate planning that I will do for clients to make sure that not only are they paying the lowest tax rate, they're also allowing their family to pay the lowest tax rate. A quick thought here, okay? While it might sound like I'm going against a qualified account or whatnot, I'm more talking about it as a type of vehicle, okay? So think of we've got a truck, an SUV, and a car. Okay, inside of those cars, I can put the same investment. I can put the same people, right? We all start off and we drive to grandma's house, all right? We get to grandma's house and we look in our gas tank and say, hey, how much gas is left, right? The truck's going to say, I have the worst miles per gallon. I have the least amount of gas left versus the car, who's a Prius, is going to have the best gas mileage, right? These types of accounts are exactly that analogy. While you are going to get to the destination, once it's time to pay money or pay the tax, how much of that money do we have left after tax? Okay. And so qualified accounts happen to be on the lowest ring of the ladder, is that more than likely or I should say, that is going to be the worst taxed account, which means you have the less actual dollar for dollar when it's distributed. Okay, leading us to our second one, the non-qualified accounts. Okay, these are brokerage accounts, high yield savings, a trust account, if you have a stock plan at work, or different cash accounts that accrue interest throughout the year. How do these ones really work? Okay, at the bottom end of this account, there's a lot of different caveats to it, but what it really does is gives us flexibility. Okay, and so what this is if you put in money, you're putting in after-tax dollars, you're putting it in the high-yield savings or buying a stock. One, they don't have a 10% penalty or a date that you can take them out. I could put 10 grand in tomorrow, take out the 10 grand the next day, right? But what they are saying is that when the trade occurs or the interest is incurred, that is going to go on your tax return in that year, whether or not you put the money in your pocket, okay? Unlike our other types of accounts, I can trade in there, I can do whatever until the money actually leaves the car, leaves the vehicle, comes into my pocket. I will not pay any tax on it or whatnot. This account is different, right? So again, if I put 10 grand in, it's now worth 10,500. That $500 with interest, that is going on my tax return in that year, even though that 10,500 remains in the bank account. Okay. And so this account I like to use more as a medium goal, right? I'm saving for the next house. I'm saving for the next car. Maybe I want to put it away. I've got too much cash. So I need to house it somewhere. Okay. But I want it to still be accessible. I'm going to talk about the capital gain. How does the tax work on these accounts? Okay. So, while this might be good for some, it might be worse for others, right? So short-term capital gains are 20%, long-term capital gains are 15%. What does that mean, right? So a short-term capital gain is something that is traded or sold within 1 year. So I bought Apple on January 1st, I sold it on July 1st, and it gained $500. I pay tax on that $500 at 20%. If I waited until January 1st of the next year, okay, that would then be taxed at 15%, or January 2nd, technically. Okay. Completely different than ordinary rates, as I say, where maybe I'm in the 22% tax bracket. I still might pay a 15% here for a long-term capital gain. All right. The most key tax implication of this is the step up in basis at death. What is that? Okay. So just like I talked about with our qualified account friends over there, when you pass away, that amount is going to be taxed to your kids as well. This account, if I have unrealized capital gains of, let's say, 100,000 and I die, my basis steps up to the fair market value of the account, which can be huge. That can save us so much money in tax, right? So it's very, very key here to look into where's my money's at, because that's going to be huge into the tax implications that you put on your estate and your children or beneficiaries. Okay. Quick thought number 2, don't have all your eggs in one basket. Each of these accounts has their pros, their cons, right? But what we don't want to do is put everything into one of the two, or eventually Roth 3 here. Okay. We want flexibility on one end. We want the tax write-off on another. We want, as I'll get to the Roth, we want the tax-free over here. All 3 of them need to work in unison. All right. We just want flexibility. We want to have money everywhere. So regardless if our plan changes, we can pivot and utilize one of the accounts to the best of our ability. Okay. Roth account types here. We've got the Roth employer plan. We've got the individual Roth IRA and the inherited Roth IRA. All right. Roth accounts, how do they actually work? Okay. You pay at today's tax rate to escape tomorrow's, but all your growth is tax-free, okay? So the IRS is saying, hey, I'll allow you to put in money today. You're going to pay us our tax, but all of that growth in the future is tax-free, okay? Contributions are not tax deductible, okay? There's still annual contribution limits. Right now that happens to be $7,000 and $8,000 if you have the catch-up, okay? And then there is some income phase out. So if I make roughly the numbers around 140,000, if I make over that for a single individual, if I make over that, they're going to start saying, hey, we're not going to allow you to put in the full amounts or any at all once you go over the cap. Principal can always be taken out tax-free. Okay, this is the really, really big special key fact that the Roth has is that, hey, if I put in 7,000 for the last, I don't know, 3 years, right? So I've got 21,000 that is my basis, and now the account is worth 30,000, and I go and deduct 20,000. The first 20,000 I take out is my basis, so I would not pay any tax or penalty on that. If I take out the above 9,000 of gain, that is where I'm going to have a 10% penalty on that amount. All right. There is no RMD on Roth IRAs, but our inherited or the beneficiaries will still have to take that money out within 10 years. All right. And the contribution date, just like a traditional IRA, is 4/15. You can backdate those contributions. Is it too good to be true? The answer is no. All right. It really is tax-free. Okay. And so this is huge when we look at planning, right? We want to get as much money into a Roth as possible while also maximizing our current day tax brackets. Right. We do have one little specialty, which is called the 5-year rule. All right. And so that means when I put in money, I can always take my principal out, but my gain I am not supposed to take out until at least 5 years later and after 59 and a half. Okay, so very, very special factor there, the 5-year rule. Last quick thought. How long will the Roth IRA survive? I am still shocked, to be quite honest, that the Roth is on the table. The Congress has continued to double down on it, actually putting it into some new tax legislation with forcing some 401ks to utilize it. To me, it is very silly, but they need the money, quite honestly. And so we will continue to take advantage of it. But if we're looking from a long-term perspective, it's a very short-sighted thing for the IRS. Okay, and so think about it this way. If I put in $10,000 into an IRA and I put in $10,000 into a Roth, and I'm at the simplest 10% tax bracket. On the Roth side, I paid my tax today, right? So I paid $1,000 in tax to do so. On the qualified side, they allowed us, we saved $1,000 in tax, right? Now let's go 20 years from now. It's time to distribute, and that 10,000 turned to 20,000. Well, remember on the Roth side, I paid $1,000. Everything I take out, all my growth is tax-free. So the most I'm ever going to pay is the 1,000. On the qualified side, sure, I saved my 1,000 when I, wrote it off then, but now it's worth 20,000 at 10% means that I'm going to pay $2,000 in tax, right? A huge thing when we look across the broad spectrum of accounts. So that is the power of the Roth IRA and why it's so important to try to put money into them. My ladder of taxation, as I mentioned, the gold standard is the Roth. The second down is the non-qualified account due to its flexibility and step up in basis. And then last is our qualified account. It's great for some people in really high tax brackets, but for the majority of people, you're probably going to pay more tax in the future because I think we all agree taxes are going to continue to increase. So we want to load as much money into the top of the ladder being Roth and trickle our way down from there. All right, a problem I see with a ton of people, all right, is that many people focus on one type of account, right? I've got all my money, I've got all my eggs in one basket, one type of account, okay? They don't put it into all three accounts or three types of accounts, I should say, or quote unquote, my buckets here, right? Why is this a risk? We have the tax risk. One, we don't know what the future tax rate is going to be. If all my money goes into just a qualified account, okay, I'm going to have RMDs. So I don't know what the tax rates are, the tax brackets in the future. I'm going to be forced to take money out. It means I'm just going to be at the, whatever the tax rate is, that's what I've got to deal with. So that is one of our risks there. Liquidity. We can't get it out until 59 and a half, or if I take it out early, I've got a 10% penalty. Passing assets to beneficiary. Maybe you in retirement are in a 10 or 12% tax bracket, but your kids are in the 22. When we look at it from a whole, the family itself is going to pay more tax on the beneficiary end. And then flexibility. All right, as I always have mentioned before, having multiple types of accounts keeps us flexible to whatever the future brings, from tax codes to life changes. Having money in all three buckets allows us to stay versatile, to hop over whatever hurdle comes our way. How do you create a custom financial plan? At the end of the day, as I mentioned, the goal is flexibility. Okay? We need to have our investments, as I mentioned, we can invest the same thing in all three types of accounts. So our rate of return can remain unchanged. We then have the account type, okay, which we, as I said, we want to leverage all three. And really, I throw in 4 accounts here, right? One being cash, okay? This is your emergency on hand for short-term goals, okay? So you don't have to sell investments at the wrong time. So we always want to have enough cash on hand to mitigate any short-term risks that we have. Qualified, take advantage of the employer match, as we mentioned, while potentially maybe this is the best account for you to save at today's tax rates. We have that non-qualified account, which has no, right, we have flexibility. We can take the money out now. It has no 10% penalty on it. Could provide a better tax situation, whether it be 20% or 15%. And it gets that step up in basis. And then Roth, the king of all accounts, we of course want to load as much money in here as possible to grow tax-free. I would say a good plan today is better than a perfect plan tomorrow. Said best here by Mr. General Patton. Okay. You having money in all of these different things might seem more challenging than it is, but starting today is only going to help you in the future. If you've got additional questions, you can go to our website. We've got our contact us page, and then you can ask for our financial wellness profile where we'll run you through a full plan of your situation. And then next month, our episode will be about year-end planning, which is going to focus on Roth conversions specifically. And then follow our socials. You're seeing this on YouTube or maybe Facebook. Give us a follow, LinkedIn as well. And then as always, I want to thank you for taking the time. Our little disclosure about contact someone. Don't just take my advice from this. Each person is different, which means that you should consult a professional and really look into your situation to make sure you set it up the best for yourself. Have a great day. We'll see you next month.